We do remember that we do this almost every month, but this month specifically is designed for us to go like a refresher course kind of to the beginning again. So this might be like very beginning, so it might not go so deep into maybe stock investing or that kind of investing, but we'll be very basic as to what you need to know before you start investing, which I think is very important, anyways, to be honest. I think it's the most important part of investing. So today, basically, we'll be talking about the first thing you need to know before you start investing. Like I mentioned, this is basically for new investors. So, in case you are looking at them like, why are you going through this all over again? The idea is to be able to give us a refresher, give us idea of what is going on, and then factor in things that you need to maybe you have not been doing, and then you need to adjust, or things that are confusing to you. This is the period or the points where you can ask questions. So I'll try as much as possible to go through the slide very fast so we have opportunity to ask questions. So I believe is those questions will be able to broaden your knowledge about investing much more. So we'll do that. But first, let's move ahead. So here it's about Vision Poeta Capital. So basically, we provide guidance, investment guidance, and consultancy to people. So what that means is that we guide you towards the investment route, so that at any point in time you want to make a call and be like, oh, there's an investment that is on at the moment, this particular stock, and they advise you on what you'll be able to do in that regard. So once you know what you want to do in that regard, then you make the investment, or you saw an investment and you are curious about what is going on in this investment part, and then you share with it. But because there's an agreement, consultancy agreement between us, we can always share that investment idea or the investment thing that is going on in the market at that moment. And the other part is education, where you learn more about stock investing. Um, so if at any point you want to learn in depth about investment, either in the capital market or the money market, that is what we do. So today we just go into like the very basics of investing, and like I mentioned, it's the very basics. So let's jump right into it. Um, so these are things that we'll discuss today. The reality, the non-negotiable, what investing look like, the starter framework. Like you are starting to um, invest, you just want to invest. What does starter framework look like? What does the very first step of you investing? So, for example, you are someone that have never invested before and you want to start. What does the starter framework look like? We'll talk about that, and then the next step on how you can get started. Um, and after all, ask questions. Ask questions, because after all, that's why you're here. So let's get started. All right. So first thing first, I want to mention is the idea of savings and then the idea of investing. The first thing you want to look into whenever you're investing is that the money that I have, will it be the same value in the next few years, right? And what makes you understand this particular thing is that if you have someone, or let's say four different persons, so I brought about four individuals here. There is person A, there is person B, there is person C, and person D. The first person have 1 million naira in 2020, that's about 6 years ago, and save that 1 million naira in, let's say, commercial bank, or save it in any other bank that you want. The truth is that 1 million naira, that 1 million naira as of today will still be 1 million naira. That's the truth. But the reality, which is different from the truth, what I mean the truth is what you'll be saying physically is that 1 million naira is 1 million naira. But in reality, that 1 million naira has made the person a bit poorer. Why is because every year the value of things or the price of things increases. And because the price of things increases, the value of that 1 million naira in real sense has reduced from that same 1 million naira. But what people do not necessarily know is that it's not just this person that become poorer in quotes. Also, if you have another person that invested 1 million naira and got 1.2 million naira, right? The fact that the person got extra 200,000 naira does not necessarily mean that the person is richer. Even though in truth and reality, okay, I will be using that two words, they might not accurately be true, anyways. So even though in the truth or in fact, right, that 1.2 million naira, the person has been richer by 200,000 naira, but it still does not mean the person is richer, because in sense of Nigeria now, our inflation rate is double digits, right, and is above 25%. So what that means is, if the inflation rate over the 5 years or the 6 years the person has held this 1 million or have invested it in it is more than 25% in quote, and the person got an investment increase of 1.2 million, which is like, let's say 200,000, the person is not richer, the person is still poor because it has not meet up to the standard. So I now put at it and say, let's say another person invested 1 million naira and got 1.2 million naira, and the inflation within that time frame has increased about 27%. So it just means that the person has just been able to preserve that 1 million naira to be same 1 million naira in 6 years if the person had invested in an asset that give about 27%. So what that means is your value of your money is the preservation of the value of your money is almost equivalent to the inflation rate in the country that you are resident in. So we have 1, preservation, and 2, abundance. So the first state is preservation, is the state where you try to find an asset that has the equivalent of the inflation rate in the country you are resident in. So for example, let's say the inflation rate in Nigeria is 20%, right? That means you need an asset that can give you that 20% every year. If the inflation like that increases about 20% anyways, right? Anything less than that, it means that you are fairly poorer. But anything that you did not even invest at all, it means the person is confidentially poorer, right? Now, if you now get to another stage where you do not just invest in an asset that give you that same value of your inflation, you invested in an asset that give you more than the inflation rate, then that's where you become richer. So the extra that is added to after inflation is what makes the person richer over time. So if you then compound that over time, that's what makes investment make sense. So what am I saying? Investment is what gives you an edge over inflation in where you are resident in, or recent investments that give you value is what is being able to preserve the value of your money over time. What this means is that there are 2 forms. 1, there is the preservation form. 2, there is the abundance form. The preservation form is that you get a return by investing that is equivalent to the inflation in that country. 2, the abundance state is that you get a return that is greater than the inflation rate in that country, if that makes sense. So if I move forward from there, is that fine? Do you understand that before I move forward? Is it clear? Since we are doing thumbs up, you can do the thumbs up any point. All right, great. Thank you. Thank you for the thumbs up. I think we are in thumbs up era. Just anyways, then the 3 negotiables before investing, right? These are super important. Like if you really now, why I'm taking this approach and not just telling you that, oh, this is what you invest in, this is what you invest in, because investment in itself is just a tool that anybody can know, but the application of it is what gives the actual result. It's not necessarily the idea, right? There are a lot of people that know about investing. There are a lot of people that can tell you that put your money in this, put your money in this. If you do this, you get 30% return. I mean, I've seen more people, maybe not more people, I've seen people that gain good results, right, good returns in an investment, and at the end of it, you do not have something sufficient to talk about after some certain year. And the reason is because there are some negotiables that you must understand. You must understand it before you go into investing. And number one is kill high interest debt. Like, you cannot do away with this. Like, I don't know how else to explain it without saying it this way. Like, one thing that affects people, especially most people that invest, is that you have a debt that is killing you in quotes, but you cannot really invest if you don't clear out that debt. At least if you don't clear out that high interest debt. So let me give you a typical example. I was speaking with someone, not quite long, right? And the person got a loan from the bank, and the loan from the bank is around, give or take, right? I don't want to measure the exact, give or take, let's say it's about 20%, right? And because it's 20% that this person is have to, the person wants to invest. But because you have loan in almost like 3 places, there is no way you want to confidently invest in some certain asset because of that high interest loan. Because by the time you are investing in it, so let's say, for example, you want to invest in startup, and this invest in startup take like some certain, maybe 2 years, 3 years, 5 years before you can get your return. But because you have an very high interest debt, what it means, you always take money from that investment. At any point whereby the person wants his money or her money back, you have to go to your investment and pick it out. So what that is doing is that it's affecting the way your investment ought to compound. That is affecting it. So one thing you want to do before you start investing is that look at where you have a very high interest debt and pay it off, right? So that when you are investing, you can invest confident. Like, you can invest with so much confidence that this money I'm putting into this investment, I'm leaving it for the next 1 year or something. But if you have an high interest thing that you have to kill, that means you have to always put your money into your investment to fulfill this, right? Or to ensure that, bad thing does not actually happen. So first thing, kill high interest debt. Like, look for it, kill it. Ensure that all your debts are minimal. If you need to take it, ensure they are minimal. And if at any point you need to take it, ensure that the interest you are getting, or the interest you were given on the debt or on the loan, versus the interest that you are getting in the investment, ensure that the interest on the investment is higher than the investment you are getting on the loan. So what does that mean? If your interest you are to pay on the debt is about 20%, ensure that the interest you are getting on the investment is at least 25%. So you have that buffer of 5% or something. Not necessarily 5%, I'm just saying you have that buffer of additional. So even if you use the money from the investment and pay back the debt, you still have some little cash left. Number 2 is emergency fund. There is no, you can't overemphasize this. You can't overemphasize the fact that you need cash. There is a mistake that most people make, right? Is the fact that you think your investment is also your emergency, right? So what do I mean by emergency fund? This is money that you have in case anything happen in your life. Money that you have in case anything happen in your life to be able to cover for that thing. So let's say, for example, there's things that you did not expect, it just happen and you have to pay for it. You pick money from the emergency fund and then set to it. But the money that you set aside for your investment should be for your investment, right? Because at the end, investment is to be able to cater for certain things in your life later on, not for immediate need, right? But the time when you need the thing for immediate need, that's fine. You can pick it up and do that, but just ensure that you have an emergency fund. So the number 1 we said, kill high interest rate, very important. Kill high interest debt rather. Number 2, ensure you have at least 3 months of your monthly living expenses saved out somewhere, right? Now, you can then take this emergency fund and put into other assets, right? There are money market asset classes or things that you can put your money into that will give you good return. It might not be the great return, but it will give you good return. Imagine someone that has an investment, let's say, for example, in real estate, and then you bought the real estate property like today, right? And you don't have emergency fund, and in the next 1 month or 2 months, something happened. It means that you have to sell off the real estate even when it has not really um, added value into it, or you have to sell it in a price that is very ridiculous because you have to cover this. But once you have your emergency for that, clear it, why you let your real estate to keep compounding in its valuation, right? If that makes sense. And the third one, which I think is super important, is setting the actual timeline destination for investment. I think this is important because earlier this year we were speaking with people about their investment goal that we had. That's the investment chart. And I was speaking with someone, and my question was, do you have a destination for your investment, or are you just investing? Right? There are two kind of person. There's someone that is just investing because they never know what will happen in the future, so you're just investing. And there is the other person that is investing because of a specific thing. So let's say, for example, the person is investing because they want to buy an estate in Ikoyi, right? And then they told him the estate in Ikoyi is about $1.2 billion, right? And then the person is investing to be able to get that done. So there is a destination, even though the actual thing might not be, there is a destination in the person's mind or what exactly the person wants. So because of that in the person's mind, there are some certain action you not take because you remember the destination, right? So let's say, for example, you want to buy an estate in Korea and it's about $1.5 billion, right? And out of the blue, you have about $1 million in quote, and someone is telling you that, oh, let's take this $1 million and let's go on vacation, or let's take this $1 million and let's go somewhere, or because of that goal in your mind, you just know that cannot work, right? Once I get the estate, maybe after the estate, and then I let you to be one of the occupants in the estate, maybe we can then use that money for vacation. But for now, because you have that thing in your mind, why there is another category that I mentioned, which is the first state, whose goal is just to invest. They just want to keep investing. Anyone is fine, to be honest, but I feel it is very important that you have a set goal in your mind and you have a timeline for it. So, for example, like the estate I mentioned that you want to buy like $1.something billion, right? You have the timeline that in the next 10 years, I want to buy this thing, right? So that thing put in your mind and be like, okay, what are the investment assets I can put in? What are the things I can invest in that can make me achieve that? But anyways, that aside, if you want to buy estate in Ikoyi, please reach out to me. I have interest too, so we can both look at it together. All right. Thank you for banking with us. So the next thing, right, is what investment is and what investment is not. What investment is not, first, is not a get-rich-quick idea. Like I mentioned, it's not just, you just want to wake up and say, and I've seen this, right, to be honest, like, you just meet people and say, like, someone asked me, like, maybe last year or something, that this investment that he's doing, can I buy Lamborghini with this investment? I said, I don't know. Like, can you quickly give me the money of Lamborghini? I say, bro, he's not giving you the money of Lamborghini. It's your money that will determine what will give you as the output. And you don't think that investment will be an idea for you to quickly rush out, right? It's compound and it makes sense because of the compounding, but it doesn't make you rich overnight, right? It does not. It has a framework and it goes through it. Yes, there's a place whereby you can do stuff. Maybe you are doing trading kind of thing, and then you can get income from it. You buy, you sell, you buy, you sell, you get income from it. But if you really want to fulfill the idea of investment, it's not a rich, quick idea scheme. And two, which everybody do not always agree, is not 100% risk-free. As much as everybody is telling you that, oh, invest, it has a risk attached to it. So every form of investment has its own level of risk attached to it. And at a point, which is not always true, at a point you will notice that the risk determines the reward. But not all the time is true. There are sometimes it's not necessarily true. Something can be volatile and still not give you the better reward, right? But that's for another day. Another thing is trading. Guys, trading is not investing. Trading, the person is trading to generate income, not because he wants to invest. So when you see people that say, oh, they are trading stock, what they are doing is basically because they are generating income. It's more like they are doing business, right? You are buying something, you are selling something, it's typical business. Why investment is not business? Investment is you want to be at peace because you are doing substantial things and you want to use it for your future. And what investment is, patience, all those things are there. So let me move a bit forward. And I have like the engine of wealth. So for the engine of wealth, I have three different personnel that I put here. The first person is myself, and the second person is called Atunke, and the third person is called Emeka, right? And these people want to more like practice the engine of wealth. Number one engine of wealth is called compounding. This compounding is so powerful that most people do not notice it. Like literally so powerful that most people do not notice. So let me give you a typical example. MTN IPO in 2019. As since 2019, if you had invested ₦1 million in MTN 2019 to 2026 is about 7 years. So if you had invested like ₦1 million in MTN in 2019, the person today we have about 10 million naira, right? So what that means, if the person do not touch it, if the person do not touch this investment at all, right, and reinvest the dividend, what does that mean? So dividend is like a quarterly payment that the company decide to pay its investor, and it's paid on yearly basis, in quotes. Like most times they pay yearly basis, even though they say it's quarterly basis, right? Why some person they pay on quarterly basis, but they will dispatch that and make the arrangements as proper, and then you receive it. So if you put those dividends back, right, into the investment and let it run like that, in 7 years the person would have moved from 1 million naira that invested in 2019 to about 10 million naira in 2026, right? Now this same person, or another person rather, called Atunke, right, invested that same 1 million naira that Muyiwa invested in 2019. But this time around, this person spent all the dividend, like use all the dividend to do several things, maybe one day or thereabout, and enjoy ourselves. So the difference between both of them is just choice, right? One decided to use the dividend, the other one decided to reinvest the dividend. And if you notice, the difference between them in time of pricing is about 4 million naira or more than 4 million naira, right? And because it's 7 years, by the time it goes to like 15 years or more, the difference between them will be so clear. Because one decides to put the money back and then let it compound, and the other one decides to spend it. But now, there's now another person called Emeka. Emeka decided that no, compounding is not for me. In fact, I'm not doing anything like that. He's putting his money in commercial account, right? He believes that, and this is a lot of people that believes that it's better for me to be seeing my money than to put in any investment. Why it does make sense, life is sometimes a bit of risk here and there. Life is a bit of risk here and there, right? Why it does make sense that you want to always see your money, you have to know that while you are young, you have to attempt on certain things, right? If you don't attempt, then you will not get the knowledge. And without getting that knowledge, you just feel like at the end of the day, you did not utilize the best out of the resources that God has given unto you, which is your money, in quotes, right? So now look at the difference between these three people. If I move a bit forward, you could see this, right? If you look at this, see the graph, everyone started at the same timeline, right, which is like ₦1 million. But gradually you begin to see that the difference becomes clear. If you give these people about 20 years, the difference between their return will be so clear that even anybody that sees it will be surprised that, boy, they both had the same money in the beginning. But the choices of where to put the money is what differentiates them, right? And that's the idea of compounding. That's how compounding saves you from every other person, right? You just ensure, let the money do its run. If you have ₦1 million and you put in investment, let it do its run. So let it say for the next 30 years is the time that you give it to it, and put into a certain investment. And every time you get return out of the investment, you put it back and let it run, right? If you practice that, I'm certain or 100% sure that you have some money to give me at the end of the day. All right, so the second part is risk and reward. Like I mentioned earlier, not true all the time, but this is something else that you want to look into, is that high returns usually come with high volatility, right? You see, like price drag. So what it means is that you see some assets, let's say for example stock can give you as high as 1,000%, right? In a year, it can give you 1,000%, and even if you invest in the US stocks, it can give you 1,000% in 1 month. It can give you 1,000%.